And joining me now with more is Eddie Ghabour, co-founder and CEO at Key Advisors Wealth Group. Eddie, great to see you this morning. And what do you think of the markets at these levels?
I think this market's going to continue to surprise to the upside over the next 12 months. As we head into August, we've told clients August, September, seasonality-wise, can be a little bit softer. But we don't expect any big drawdown because so many people have missed this rally, especially a lot of hedge funds and larger institutions. So we think any 3 to 5% dip that you might see heading into August, September will be aggressively bought. But the setup is as good as you could want to see it from an investment perspective. And unless we go into a recession, we still think there's plenty of upside in this market, and we don't see a recession on the horizon anytime in the next 12 months.
All right, Eddie. So then let's talk about, with a market like this, where do you see opportunity? Where are you investing or talking to your clients about investing their assets?
Well, the one thing that's developed over the last couple of weeks, which we find to be extremely even more bullish, is things are broadening out. We've been really overweight technology, and over the last few weeks, we have started to broaden out. We think financials are a great place to diversify. Material stocks as well, too, is an area to diversify. Small caps have really caught a bid. We added them a few weeks ago. And you're even starting to see housing looks like it has bottomed. So as well as Bitcoin, we have a Bitcoin ETF in our strategies now that we added on June the 2nd. And so, again, this market is really broadening out. And it's nice to see that it's more than just tech that is doing well now. And matter of fact, tech over the last few days has underperformed because of this broadening out. And so I think you'll continue to see that consistent thesis if the economy continues to do well, and we think that will be the theme over the next 12 months.
Okay, so then let's talk about, Eddie, some key events on the horizon. Obviously, we're still in the midst of earnings season. We will have some big technology results on tap, certainly next week, and more results in the weeks ahead. The Federal Reserve is set to meet next week, and of course, we've heard President Donald Trump be quite vocal in his disappointment with the Fed chair. How does that factor into your thesis when it comes to investing?
It's a non-factor. I mean, obviously, President Trump has been pounding the table on cutting rates. And frankly, at this point in time, I think when you look at the last time the Fed cut rates and look at the data now versus the last time, it's hard to justify them not cutting. But we don't think they're going to cut rates next week. And President Trump will continue to criticize them. And it's had zero impact on the market. The market has continued to rise throughout this because the market cares more about the bond market than it does the narrative between President Trump and Powell. So we don't think the Fed's going to cut rates until September. But the one thing investors need to look at from a rate cutting cycle perspective is, instead of worrying about what they're going to do next week, is what do we think the trend's going to be over the next 6 to 12 months? And I think it's safe to say over the next 6 to 12 months, they will be cutting rates, not raising rates. And on the margins, that's positive.
So what is going in to your thesis that this is the best market setup, I think I see, Eddie, that you've seen in 30 years?
Well, it's interesting. This has probably been the most hated bull market in 30 years because there's many that continue to doubt it when you look at how people are positioned. But when you take a step back and look at what's going to happen over the next 12 months, we have, whether you agree with them or not, we don't worry about it. We worry about what it affects the market. And you have tax cuts, which increases liquidity. You have deregulation that is bullish for markets. You have a Fed that's going to be cutting rates. You have a dollar that's going to continue to stay weak. And you have the entire globe is going to be cutting interest rates. So you have a bazooka of liquidity that's going to be hitting a market and an economy that is not in a recession. And when you do that, you take asset prices to continue to be more and more overbought. So this is why we continue to think there's probably 20% more upside in this market over the next 12 months.
How can small cap companies navigate this environment, Eddie? Because we have seen them lag behind quite a bit, and certainly higher interest rates could be a factor there. Finding the right talent is a factor too. But how are you confident that they will be able to gain like we've seen other sectors in this market?
So small caps have probably been the most hated area to be in. It's been very frustrating for investors in small caps because they have underperformed. They're not even back to where they were in 2021. The reason why we have confidence that this position is going to work over the next 12 months is because we think now, when we go into the fourth quarter of this year, We think the trend is going to be growth accelerating because right now it's starting to soften a little bit. We think we're going to see growth accelerate, and we think interest rates are going to trend down starting the fourth quarter. When you get that environment, it should be very, very good for small caps. Now, if we're wrong, we'll have to pivot and sell out of small caps. We're not just going to hold it and buy it down, but we're up pretty decently on our first purchase here, and we'll have to wait and see if our thesis plays out. But it's really a play on a non-recession, interest rates, and inflation trending downward over the next 12 months.
With central bankers around the world lowering those interest rates, as you've referenced, Eddie, and certainly as we've seen, are there international plays that look attractive to you?
You know, I think for investors, if you want to just buy some type of global ETF, because international markets with a weak dollar should continue to do well. You know, one of the things that's flying under the radar is when you look at China's stock market, you look at Europe, China's stock market's actually doing really well. And so owning a global ETF right now, we do not have it in our tactical strategy, but we recognize that with a weak dollar and the point that you made with them cutting interest rates, it's a great way to go outside the U.S. And diversify and probably outperform on a relative basis.
Is that a performance that you think can be sustained?
This performance, I do think, can be sustained. And again, I think the surprise from a market standpoint, and this is a non-consensus viewpoint, the surprise is going to be to the upside, not to the downside. I think right now, when you hear what people are talking about in the narrative, or you're on Twitter or wherever, everyone is waiting for this next drop because the market has gone up so high, so fast. And as long as people continue to think that, it probably won't happen.
Eddie, it's great to have you. We're going to take some remarks in our boardroom here. Eddie Ghabour, co-founder, CEO at Key Advisors Wealth Management. Thanks as always.